Good afternoon, ladies and gentlemen. Welcome to the MJ Hudson Group PLC preliminary results for 2021 investor presentation. Throughout the presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and will publish responses where appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Matthew Hudson, CEO, Odie Lahav, COO, and Peter Connell, CFO. Good afternoon to you.
Good afternoon, and thank you, and greetings everybody. So we're going to present to you for roughly half an hour before Q&A. I will take the first part, the summary. Odie will run the operating review as COO, and Peter clearly the financial review as CFO. Next slide. So in terms of the summary for our financial year ending June 2021, and indeed, we're also going to cover a bit about current trading as well in the year we're in right now. Fundamentally, we've delivered on the IPO strategy. We IPO'd on the day of the general election, if you can remember that, in December 2019, which I was told was a very hard thing to do. The only other IPO of significance in that week was another very small company called Saudi Aramco. And is also 2 weeks before Brexit and what transpired to be 2 months before a global pandemic. So much so we actually thought about changing the name of the IPO to Initial Pandemic Offering. And when I say we delivered, what I mean by that is that we've done what we said we'd do on the IPO. We've grown significantly. We've invested in technology and infrastructure. We've made acquisitions, and these acquisitions are bolt-ons essentially. Small bolt-ons, which make a lot of client sense, typically companies we know and services we understand, which add something to our end-to-end service platform. And we've integrated these relatively fast and easily because we know them into our platform. The second point is in terms of key milestones, we're still we're at double-digit organic growth, and we've also put in place. This is our first full year we're reporting on since the IPO. We've put in place a long-term debt facility to do M&A with Santander at a good margin rate. We're announcing our maiden dividend. Although we're a growth company, we said at the IPO we put in place a progressive dividend policy. And this is the first dividend, as we promised we would deliver. We've also, in terms of milestones, we've really established ourselves as a market leader in ESG in our client market, which is the alternative asset management industry, which is private equity, venture capital, private debt, real estate infrastructure, renewables. We're ahead of our competitors in ESG reporting. We've nearly doubled our revenues in ESG to the year June 21. We've also launched a new digital platform, and our first white label partnership contract there is with Mitsubishi Bank, one of the top 10 banks in the world, and that's helped our business model to, in addition, add, if I call it the Ocado type deal. In other words, Ocado were a grocer, they still are a grocer, but they also provide their technology infrastructure on a white label basis, and so do we now on ESG. In terms of growth, I touched on it already, double-digit organic growth and profit growth. We've doubled our Ebitda since the IPO. We've made 8 acquisitions since 2018, which have integrated well, as I mentioned. Also, a growing proportion of our revenue is high margin data, ESG, and analytical services, which I'll touch on in a moment. Essentially, we're a growth business and also in a growth client market. Point 4, our brand is increasingly powerful. We have over 1,000 clients now, so well diversified in our niche. We've added greater scale. We've We've got good client retention metrics, and we're growing our market share, even though we're still a fraction of our market in terms of where we can get to. We're well known in our client industry of private equity, private debt, venture capital, etc., as I mentioned, as being clever. These are words our clients use, by the way. We're useful to them, we're reliable to them, and increasingly we're a leader in our field, which has led us from, in our 11 years since we started from scratch, has led us to not only work with small and mid-cap clients, but also some bigger names like Morgan Stanley Asset Management, Goldman Sachs Asset Management, pension schemes like M&S and Lloyds Bank, and other FTSE 100 companies like ICG or Aberdeen. In terms of market themes, these are the key drivers of our revenue, which is what's happening to our clients. So the three big drivers for us, and I'll come to touch on the pandemic while I'm at it. First one is capital inflows into alternative assets. There was a bit of a freezing of new fund launches, a bit of a freezing of increased assets under management during calendar year 2020 in the early months of the lockdowns. But that was not lost revenue, that was postponed revenue, and that's bounced back now. So there's more money going into private funds. I'm sure you will read the papers about private equities everywhere. The second big of the three themes is increased regulation and stakeholder demands, particularly, and ESG is a very good example of that. This is all about transparency in our client industry, where we're a provider of that. And the third key point is a greater need for outsourcing. So our clients outsource some of their activities to us, which is partly about cost, but it's also about skills. Moving on. These are just some numbers, snapshots of where we're at. I've already mentioned over 1,000 clients, and 18 of the FTSE 100, either in terms of financial institutions or in terms of their pension plans. Next slide. So this is what we do. And so these bold letters in this slide, so we help our clients do these things. So they launch portfolios and launch funds, and we help them in that launching phase. We then help them grow. So what we do there is that we provide mid and back office or regulatory and risk and administration services to their funds once they're launched. Once they start making investments, we help them report on those investments and their performance, their cost, their ESG, and other metrics. We also benchmark them as well. And then it repeats. So hopefully we've all learned lessons from this. And when they launch their next funds, then those funds can learn from the previous funds. And these funds which we help launch, they typically last, in our world, up to 15 years. So they're long term. We follow that journey, and then they launch more funds, which again run 15 years. So these are long term revenues which we have. And the industry, the asset management industry, is over $100 trillion now, although the alternatives part is a smaller component of that. Moving on. In terms of the way we break down, the three divisions in terms of our business, again, follows that journey I mentioned earlier. There's the launching stage, which is our advisory division, which is lawyers helping build funds, and also investment consultants helping build portfolios. And although that's more advisory based, these are long term. These revenues keep on running and running and running. They repeat, because once you're the lawyer of record on a fund, at the beginning, you typically are for the whole 15 years. Similarly, the pension fund mandates are typically 3 to 5 years. So that's the launching. That's a slightly lower margin business because it's more people-based. It's like Accenture, if you wish, as a comparable. In terms of the outsourcing, that's where the funds are now launched, as I mentioned earlier. We provide mid and back office services, regulatory services, administration services to these funds. It's more about processes. The contracts are typically follow the management fee cycle, so it's based on what's the management fees, and we take a fraction of the management fees. And that's like, if in comparable sense, in the UK stock market, that's like a company called SAN, which is currently going private, so I think you probably know. And then the third piece of what we do, the reporting piece, is data and analytics. We capture a vast amount of data in the private funds world, which we've either built ourselves or we've acquired it through the acquisitions. We then splice and dice this data and provide analytical services across areas such as ESG and performance and costs, and Odie's going to talk more to that. And that's a higher margin business because basically that's a technology business. It's mathematics and it's software, and it sells into the really big clients. This is where we find it easier to sell this particular service on data analytics. Moving on. And I'll pass over to my COO, Odie.
Thank you, Matthew. So just to cover overall performance for the year, we're very pleased with the operating performance of the company, and particularly after a very challenging first half as a result of COVID and lockdowns and some of the impact of that on our business. All three divisions did well in the second half of the year. We made 3 acquisitions, all of which were strategically important for us, and we'll talk a little bit about that as I go through each of the divisions. The business continues to mature from our perspective, and we're seeing evidence of that as we win bigger and bigger clients, and also the clients, the larger clients that are using us in the past were likely only using one service, and now we're seeing those clients using more and more of our services, and we've got some good examples of that happening. And then the last of the major themes is, and we'll cover this also in more detail, is our continued investment in technology. And the idea behind that, as we mentioned in the past, is around making ourselves more efficient and more technologically enabled as a business, and also harnessing the data and all of the intellectual property that we have to create new products and solutions for our clients. And in some cases, packaging up some of the things that we would otherwise have done in an advisory sense for our clients as well, which I think that Matthew talked about. Moving on. So the advisory business, as Matthew mentioned, this is a law firm focused on private market investments, and an investment consultancy business focused on pension funds. This is the area, when I talked about being, that we were hit by the pandemic, this is the area that was hardest hit by the pandemic and the lockdowns. It was really the financial year was a tale of two halves. The first half, we had the delays in transactions, as Matthew was mentioning, where people who were going to launch funds just put it on pause and waited until post-lockdown when things were a bit more secure, and decided to go into the market. And we've got a good example of that just in the box on the right. The investment advisory business had a slow first half from a revenue perspective, really for a different reason, is that we made the decision that we wanted to move into different markets outside of the UK, which is the core market in that business. And we had some fairly operationally intensive work that we were doing for some clients, but they were outside of the UK, and we thought that it was worth doing, even though it was low margin. And that has paid off, we think, in the kinds of clients that we've won on the back of that work. So both of those businesses have recovered in the second half. And the example that we have on the right-hand side is kind of a classic case of a client. We have a regional private equity fund client, it's a classic law firm client, wanted to go to market at the end of 2020, delayed that, ended up going in the second half of our year, so the beginning half of this year, to a successful fund launch, and post that launch is now using 3 of our services. We think this client is very likely going to be in our top 10 revenue clients for the year, and this is again a classic case of the law firm acting as the shop front window for the rest of the business and the rest of the services as well. The one thing I should say on the law firm, we also reorganized a little bit in the beginning of the year. We took the opportunity, did a little bit of staff reductions, and also we closed our Guernsey law business. And that has meant that although revenues had come down, we significantly improved the margins in that business, and Peter will talk a little bit more about that later in the financial review. Investment advisory, strong gains in the second half of the year. There's been a focus on a different pricing model, and emphasizing that and focusing on that as a core part of the business and on the offering. And that is going to enable us to really increase the margins in that business and scale that business going forward. We've won several clients now outside of the UK, which is great. We've got a new sovereign mandate. And post year end as well, we have a material client win, which is a multi-year client win, which will very likely be in the top 10 clients for the business in years to come. So great momentum the second half of the year, heading into the current trading year that we're in today. Moving on. The outsourcing division, again, to Matthew's point, this is middle back office services and regulatory solutions for fund managers and funds. We had growth across this division, very, very strong growth in our AFIM business, both in Luxembourg, which we used to call an organic investment, which is now moving into the outsourcing division where it naturally sits, and also our AFIM in our management company in Dublin, which was the acquisition of Bridge. We did have great performance from the regulatory solutions business as well, and fund admin also hit a new stage of growth, which is great. Again, this is fund admin for private equity funds primarily, but private markets funds more generally. Some good client wins in the UK, and that was bolstered as well, both from a team perspective as well as additional clients perspective post year end, with our acquisition of Safri Champness, which closed a few weeks ago. If we could just kind of we also had, I should say, we had a little bit of a challenging period in the Channel Islands in the fiduciary space. The lockdowns in particular hit the sales process quite hard there, and so we didn't achieve the level of sales that we were hoping for. But we have seen that trend turn around in FY22, so the current trading year. If we just go back to Bridge and the acquisition, you may recall this was a strategically important acquisition to us because it brought in the fourth of the core fund centres where people launch funds in Europe, which was Dublin. It's also a business and a jurisdiction which has benefited from a change of regulation, which was basically encouraging people to use AFIM-like services or have to launch their own fund management company in Dublin. And you can see the two things, the only things that we bolded on the presentation, and if you can see it, is AUM and 49 billion. This business grew from 6.3 billion euros to 49 billion euros in 7 months. And we're seeing that momentum continue as well into this current financial year. Next slide, please. So data and analytics, again, to Matthew's point, this is where we sell data and analytical services in the form of software, typically, to cover risk analytics, performance analytics, ESG, and benchmarking. ESG is going to get its own slide, so I won't talk too much about that here. But again, great performance overall within the division. We are very pleased with it. Importantly, in the financial year that just passed, we completed 2 key acquisitions that were a core part of what a data and analytics offering should be in private markets, and that is adding risk analytics and adding performance analytics. Parax was the performance analytics tool that we bought and business, and Claris Risk, which came right at the end of the financial year and wouldn't have impacted the numbers, but was another key building block in what it is that we were trying to build. So we've got the core rounded out service now. Performance analytics so far has done really well. We're in line with what we expected, and we've also one of the things we really liked about that business, I think we probably talked about it last time, was the types of clients that business has in the client base, which includes some really big blue chip private markets names in the States and in Europe. These are what we would term as household names in the private market sector, and we've got those clients which we've now opened up relationships with. Aside from that, custodian bank benchmarking is another area in the business which hit a milestone. A little bit subdued sales. We had a transition plan that we started executing at the beginning of this calendar year, so the second half of the year, which was as the founders, this is the old Amices business that we acquired a few years ago before our IPO. As the founders rolled off as part of the plan, was going to be after 3 years. We were going to have to change management and let the next level down really take over the business and run it. And that was something that was in the works for a couple of years, and we started that transition in the second half of the year. That did cause a bit of a delay as focus shifted to ensuring that things ran smoothly, but really pleased to say that we didn't lose any clients as a result of the change. The two founders are still involved and kind of helping out with bits and pieces, but new management has taken over, and we've seen some of the sales momentum reverse, particularly in the US, as we've had some great wins earlier in this year so far. Aside from that, we in the box on the right-hand side, we announced a few weeks ago a new joint venture called Fides IQ. This is a joint venture between ourselves and the management of the business, and management is led by a lady called Sarah Smart, who's very well known in the pension fund industry in the UK. Is involved and chairs the pensions regulator, and has had a tremendous amount of experience working with trustee groups in pension funds in the UK. And the idea behind the business, leveraging the software that we already had, so this is built on the Advantage IQ platform, which we've talked about in the past, and which is a kind of a core building block in our application suite. The idea is to run a governance and decision-making effectiveness tool to allow pension fund trustees and really any kind of investment decision maker test whether their decisions have been good and whether they've been effective over time. And this is a core focus in pension funds go forward, but would really be useful to others as well. The product hasn't launched yet. We have done some pre-market testing with clients, which has been very, very positive, and we're going to officially launch in 2022. If we can go to the next slide. ESG and sustainability, as promised, we've got a slide all on its own. This is an area of really significant growth, and personally in my career I've not seen a change quite as rapid as this before in the financial markets, but it's fundamental to the way people do business in the sector, and I think it's going to continue to be that way for the next few years. You can see in the bar chart how our revenues are not only growing but accelerating. We've nearly doubled the amount of revenue in the last year, nearly 100% client retention, and of the clients, nearly 100% of those clients are asking us for more services. We've added several new client relationships, and none of this includes the system, which Matthew talked about, which is on the box on the right, which I'll talk about in a sec. So all of this is the old business, as it were. In 2021, we saw some really good margins in that business as well. We're not going to see as high margins as we are investing in growth and we're scaling the team. So you may recall that when we acquired this business a couple of years ago, we had a team of 12 professionals. We're now a team of 40. It used to be just in Amsterdam. We now have a team in Amsterdam. We have 8 people based in London as well, including some senior staff. And we are looking to create a presence in New York early next year and to expand into the US, because that market is also opening up as well. If we just move on to the box on the right-hand side there, you've got ESG Advantage, which is a new ESG system which we just launched a few weeks ago. There's some awards banners at the bottom. The drawdown awards are big awards in the private market space. We won those awards before we officially launched the system, as a consumer system, as it were, for the outside world. The system we had before was much more internally focused. And the idea is we provide a full kind of end-to-end platform for built primarily for private markets and with private markets companies and investment managers and investors in mind. And it does all of the data collection. It provides a framework for assessment. It does the process management, and it provides reporting and regulatory services as well. And it's a SaaS model, which basically means obviously people subscribe to the software as a service, but we will continue to improve it for example, your iPhone's iOS platform. So we'll just, if the regulator changes their reporting requirements, we'll create a new module and we'll build it into the system, and anyone who subscribes will just be able to get access to that. So the idea is that it'll just continue to grow and scale and be a useful tool for our clients. Our current, Matthew talked a little bit about the bank partnership that we have, which obviously we're very, very excited about and seeing where that can take us. But even the direct sales pipeline post-launch has been really phenomenal. we thought this would be much more attractive to lower price point, smaller mid-sized managers, but actually we've seen some very, very large managers come to us to solve a whole bunch of different problems and looking to either just subscribe to the system or possibly white label it even. And again, this is like FIDES IQ. This is built on the Advantage IQ platform. Next slide, please. So just wrapping up the operational review, we talked a little bit about technology in the beginning. It's been a busy and really transformative year for us here. The strategy, just to reiterate what I said earlier, is to really make our operations a lot more technology enabled, to help us become more efficient as an organization, and also help us integrate companies as we acquire them, and really build a very robust platform from a technology perspective for ourselves. So that's one side, and the other side is to harness our unique data set and our expertise and our position in the market and create systems and tools and software for our clients. We've upgraded, so in terms of the infrastructure, we've upgraded the infrastructure. You'll see some probably names that you'll recognize, like Salesforce and Workday on the right-hand side. A lot of the work was done in the last financial year. Some of it is really only coming to the fore here. But again, this will help us not only make ourselves more efficient, but also with the integration, as I mentioned. And then when it comes to application development and things that we build for our clients, we've really enhanced and expanded our research and development capabilities. And this isn't just things that I put in the bottom box on the right-hand side, which talks about the talent and machine learning and NLP. It's not just about the tech people. It's also bringing in innovators, researchers, PhDs. And some of those came through the acquisitions that we've made in the last year and in years before. And some of it is us hiring those people and focusing on innovation as a company and backing that up with a team from technology. So we have a team of 23 people now across infrastructure and application development, which means a lot less reliance on external providers, a lot more stuff grown in-house. We have 11 developers, and that excludes the engineers, quantitative engineers that we have, and people that we have that are already in the business, which are also technologically savvy, which we've got in several of the business lines. And one of the ways we're trying to scale this and build this out in an efficient way is just thinking about where we hire these people. So we opened an office in Colombo in Sri Lanka, just as another place that we can source talent from, but also where we can scale more efficiently. So that team today, we opened that office earlier this year. The team today is 8 and growing. And we have, aside from those and outside of the count of 23, we also have some open data positions. So we're starting to look at data scientists and basically data professionals and building out a core in Sri Lanka to help us with that side of the business. And with that, I'll hand back over to Peter. So if you want to go to the next slide, Peter, over to you.
Thank you. Moving on to the next one, please. Thank you. The financial highlights. Our underlying revenue up 26% from 20 million to 25.5. Organic revenue 4% to 14 for the full year. If you saw the half year numbers, we were at 4% at that point. So you can see the second half growth is strong, which I'll cover more on the next slide. Ebitda up strongly from 3.8 to 5.6 million. The end pre-tax profits 2.4 compared to 0.9. Our earnings per share is up from 0.5p to 1.3p. As Matthew mentioned earlier, we've declared our first final dividend of 0.125p per share, which is the beginning of our progressive dividend policy that we've spoken about consistently since the time of the IPO. As mentioned previously, our margins are up in the year from 19% to 22%, and our net debt position at the end of the year is sort of 6.9 compared to 10 the previous year. Just moving on, please. Thank you. The two charts here, revenue and Ebitda, just the revenue number is just showing you the growth in the half years over the last 3 years, covering the period since IPO. 14 million of revenue in the second half. In the bottom chart on Ebitda there, you'll see you've got the bottom two bars of 3.8 to 5.6 current. With the acquisitions that we've acquired, had we owned them for the whole of the financial year on a pro forma basis, our Ebitda would have been 6.8 million. That excludes the acquisition that we closed in October. So we're carrying north of 7 million of pro forma Ebitda into the current financial year that we're in now. And next slide, please. We've talked another consistent theme through IPO and to now is the levelling up of our divisions. So when we came to market in 2019, the advisory division was about half of our revenue, more than half of our people, and more than half of the Ebitda. You'll see in these three charts, in terms of people now, advisory 27%, outsourcing is now the largest, and the Irish Bridge acquisition has pushed that forward in the year. Data analytics 26%. By revenue, outsourcing is now caught up, advisory, and will overtake it in the current financial year, and data analytics 26%. And in terms of profitability, your highest margin and numbers there coming through from data analytics, as you'd expect. So as we're levelling up across the divisions, why are we doing that? There's increasing contracted and recurring revenue in outsourcing and data analytics compared to advisory, where there's a very strong repeat revenue within there, but not so much contracted. But you can see at the bottom of the slide there that our recurring and repeat is up slightly at 86% in FY21 compared to 84% the year before. Next slide, please. This is a chart, table that's in the RNS, so you can look at it in there as well. Just comparing the performance of our divisions year on year. So just going from left to right, in advisory, a small contraction in the year. We were 9% down at the half year, so you can see that's grown in the second half. Margin improvement that Odie mentioned previously, up from 14% last year to 19% this year. In outsourcing, very strong growth. Large part of that driven off of the Irish Bridge acquisition, and the margins down slightly. Our margin for FY20 across the board was inflated because we took some fairly significant expenditure reductions when COVID kicked in the last quarter of the financial year 20. So all of our staff took pay cuts. We reduced holiday pay, and a number of factors there which improved those margins. So we certainly didn't expect the 43% in outsourcing to maintain. The other downward pressure on the outsourcing margin Odie's referred to as the Jersey admin business, which has just taken longer to integrate and get its sales pipeline back, but that's all improving in the current year. Data analytics, 43% growth. That's pretty largely organic in the year, driven by the really strong growth in Esg. Margin up from 1.4 to 2 in the year. And our organic investments, we've mentioned before, where we haven't found anything to acquire, we have set businesses up in the past. So in Luxembourg, fund administration and reg solutions, all of those businesses are now at the level of maturity where they will all slot into the outsourcing division in the current financial year. So we currently have nothing in our organic investments part in FY22. So all of those, their natural home is in outsourcing, so they will move across there for the next year. Next slide, please. Then just finally from me, just a quick look at the balance sheet in terms of significant moves there. Non-current assets, obviously a large part of that is driven by M&A, but we have actually spent, as Odie's referred to, we spent £2 million in terms of investment in software development over the year. So software and product development, significant spend there, and obviously we expect to see multiples of that number coming through in revenue over the years. Another theme we've noticed during the lockdowns was that, as well as the temporary stop fund launches, which worked through quite quickly, it has been taking longer to get things done. So our WIP and debtor days are slightly up compared to the previous year still, but we expect that to wash through over the next 2 quarters completely. But there's still we're still experiencing some of that delay in the numbers. And borrowings, the increase there relates to the Santander facilities Matthew mentioned. It's a good margin. It's a 5-year facility with a single repayment in 2026 from Santander. So I'll hand back to Odie for trading update.
Yeah, so next slide. Thank you. So yeah, this is just kind of to wrap up and just to give you a flavour for what's happened since June of 2021. In short, the key themes that Matthew talked about right in the beginning, which is growth in AUM and alternatives, regulation, and generally hassle, and the outsourcing trend are all still very much in force this current year, and we are seeing that. we're seeing the momentum that started in the second half of our financial year continue into this year across all three divisions. And we still have those bright shining light businesses. So the Bridge acquisition and the AFM in Dublin, as well as ESG, which still stand out in terms of that growth and that momentum as they carry forward into this year. You'll continue to see us invest in technology. Some of the systems, particularly the infrastructure upgrades that we've been talking about, have a lot of milestones in this financial year, and we should be wrapping up the vast majority of those. And in terms of applications and software development, as it were, ESG is a SaaS business, so we're going to continue to work on that and develop it over time and ensure that we do win when it comes to that land grab opportunity that we've got in ESG tech. But also, we're very much looking forward to the FIDES IQ system launching, hopefully to great success. And what we haven't talked about is just the value of the data. Once we've got that system, if it is successful, the value of the data and the knowledge of why people make decisions and which decisions have been effective or not is going to be very, very useful to loads of different market participants. So all that, and sorry, and the acquisitions are all integrating well at different levels, but we expect to see some cost synergies come through in some of them. We're already seeing some of the benefits of the revenue synergies. We talked a little bit about Perax and the ability to sell to large institutional kind of the brand names in the US and blue chip clients. So very, very confident in the progress through this year, and that's going to continue for the foreseeable future, really. So with that, we're going to head into Q&A, and I'm before Matthew's final comments thereafter. So I'll start us off. So we had a question from early on in the presentation, which said, can you talk about your revenue mix, which I think we've done a little bit, contract length, sales process, who are you displacing or competing with when you win new business? So I think probably best to go to Matthew. Matthew?
Yeah, so I don't mind to go slightly backwards on that. So in terms of who we're displacing, that's a really interesting question, because actually we're largely, almost the biggest competitor to us is the clients. Certainly, if you look at people like listed FTSE 100 asset managers, they've got a lot of lawyers in-house helping them launch funds. They have investment professionals, clearly, who analyze what they're doing. On the advisory side, they typically have their own mid-desk and back desk operations. The thing they don't have is the data across the industry and the analytics, which is why we sell that service, as already mentioned, to really big players, because it doesn't matter what you got internally, you don't have that data, and they want that objective analytics as well. When we first started the business from scratch, it was essentially to help democratize the industry. It was in the middle of the GFC, and teams coming out of banks, and they needed the infrastructure. And if you're Blackstone, that was cool. You had it all yourself. But if you weren't Blackstone or BlackRock or a big player, then you didn't. But now we find that certainly on the analytics side, that the big people want our service as well. I know this is a much overused word, but we are unique. There's not a direct lookalike to us out there. And I think that's because we essentially feel like we're part of the clients, hence the comment about competitive framework. In the US, although it is believed that about only 20% of the what we call outsourcing is outsourced from the alternative asset management industry. The rest is done in-house. Clearly, there are external providers of each one. In terms of the contracts, I think we touched on this earlier, the legal contracts, even though they're not fixed for years, they run for years. We've got examples where we launched Fund 1, and then Fund 2, then Fund 3, and we're still lawyers on all of these in Fund 1, 10 years later. The pensions, as I mentioned, is 3 to 5 years typically. And in the outsourcing, it's typically annual notice periods, but reality is particularly because we're more of a mid-office player than a back-office player, unlike, say, a SAN or JTC, which are listed companies. So we're right in the client, so it typically lasts for years. They follow the management fee cycle, so quarterly, BIPS based, percentage based. Now, in the analytics side, the contracts are again, if they're part of the new platform launch, then they're essentially annual. When I say annual, I mean that they don't renew every year. They just keep going, but you could give notice technically. I mean, there's virtually no company out there, whatever they say about. I read recently some people talk about multi-decade contracts. So all contracts can be terminated, virtually without exception. So, but they typically run for a long time. Peter mentioned that over 8% of our contracts repeat or recur.
Okay, thank you, Matthew. Next question is probably for me, but please, Matthew or Peter, jump in afterwards. How do you see the relationship between increasing technology offering and your margins? So I guess first and foremost, we are a growth company, and where we see opportunities, we're going to invest in those opportunities because we think we can do a good job and make a lot of revenues and increase the margins in the longer term and the medium term. So some of these things that we're doing do require investment and will potentially reduce margins in the very short term. That said, I think it's quite important that one, it's kind of we just explain that the way we, aside from the things that we've acquired, so the way we built, for example, the IQ platform was almost as a no regrets type of investment, right? So we need the platform in order to help ourselves run our AFIM business better, so we built a RegTech platform. Sorry, our audit representative principal business. So we built a RegTech platform. We needed it to support the investment advisory business, so we're using it as a due diligence platform. We needed to digitize and create a lot more infrastructure around the ESG business when we bought it a couple of years ago. So we built that into IQ. So all of those things were built into the same base. And all of those things make our core business run more efficiently and smoothly, as well as being potentially products that we can commercialize in the future. So we do think about the margins, and we think about the margins of the existing business line, but it doesn't take away from my original point, which is where we see a really good growth opportunity, particularly when it comes to technology, we will invest in it, and you will probably see the margins reduce to some extent in the short term. Matthew, would you add anything to that?
No, that's very good.
Okay, thank you. So another question. You are operating in a growth market and appear to have delivered all the promises at the time of the IPO. So why do you think your share price remains at a sizable discount to the IPO price, especially since the market has risen strongly over the last couple of years? At the risk of poking a bear as the largest shareholder, Matthew.
So bears do when they get so. Yeah, I mean, the shares rose a little bit off the IPO, and then the pandemic hit and everything collapsed, and we collapsed with it. So I thought, that's great. We're collapsing with everybody else, we're moving with the market. And then we've been crawling our way back, but we haven't crawled all the way back. So I mean, the honest answer, I wish I knew the answer. But it is frustrating, it has to be said. It's particularly frustrating when you see our competitors, our listed comps, which are very few, by the way, being taken out at considerably higher valuations, albeit they're bigger companies. So
I think there's a helpful question that's related, which is, are you comfortable with your shareholder base, or is it the cause for the unexciting share price performance?
Yeah, I mean, I can answer that as well, Odie, and whoever asked the question. So we've had some churn, if that's the right term, in that we've had some of our shareholders sell, because we IPO'd and it was a primary raise only, not a secondary. So it wasn't an exit as such. We've had some selling. We've had 1-2 shareholders institutions who something's happened to them, which they say it's not us, it's them, like being dumped. But they've had internal issues and they're sold. So there has been selling pressure. I think that's slightly reversed, because you probably noticed they recently, I think it's 14 million shares traded in a heartbeat, which is brokered by our broker Senkos. So I'm hoping the share price, there'll be less selling pressure going forward, particularly now we've got our results out as well. And thank you for saying we've delivered. I feel we have. And it hasn't been easy. It's been quite tough. I mentioned, we 2 weeks before Brexit, 2 months before the global pandemic. So we feel reasonably pleased with ourselves. And we think we've built it to a nice place now as a business, made a lot of investment. It feels good. And we're riding, some good growth trends. But yes, there has been some shareholders who've left, and we have to deal with that. But hopefully we can grow from here with less selling pressure.
I think a question for Peter. Can you add some color around expected credit losses on trade receivables and contract asset? It seems to represent a reasonable proportion of the receivables balance. And given the client-based nature of activities, I would not have thought bad debts is a material risk unless a fund blew up. Excuse the jargon. Peter.
Yeah, of course. Yeah, there's a couple of significant balances in there which are distorting the number upwards, and they link to the pay-away business. Within our AFIM business, we have a lot of funds where there is revenue coming in gross, it's immediately paid away, which is why our gross revenue you see in the accounts is nearly 40 million, whereas we refer always to underlying revenue to take that out. 2 of those actually relate to those categories, so there's offset actually in the payables side with them, and the net impact for our business is lower, but of course we have to gross up in the debtor side, which is why those numbers look high. I agree they look higher than you would expect them to be for our business, because we don't have a significant underlying bad debt problem within the business, but there are a couple of one-offs in there. And obviously, as you'll have seen as well, EY have come in and taken a more rigorous approach to this as well. So you'll see the prior year number has gone up by 300,000. And so and that rigor has fallen through into this year. So we would expect that number to come back in reality through the P&L over time.
Okay. I've got one more, I know probably Matthew, but either Matthew or Peter, as a question around why it's taken so long to get the results out.
Well, let me answer that, because Peter's a CFO and he's obviously the coalface of that. We want to build a big company, and as part of that, we felt that after 3 or 4 years of BDO, we should go to a Big Four auditor. Being a first audit with a Big Four, it took longer than we thought, and then we made a mistake, which is that we said that it would come out at a certain day, and EY, they said, well, they're not interested in what day you say, and so we're a bit late as well. So it feels a bit like a bit of an own goal on our side. We will do better in our current year and get it out quicker. We're very broadly happy with, must be said, with the audit, the clean audit, and my finance team's done a lot of hard work on this, but there's definitely room for improvement next time.
Okay, next one's probably for me. I think it's a typo probably. There's a, do you own the data you capture and can you resell? I guess the short answer is it's mixed. We own some of it. We have the right to use some of it in certain ways, and we can resell some, but not all. And in a lot of cases, what we built into contracts is an ability to aggregate and sell aggregated data, even if we can't sell, specific data that relates to specific clients or different things like that. So we in our contract, as you can imagine, we have quite a lot of lawyers who work here. So in our contract, we've been quite strategic, knowing that we have this data analytics business and this desire to embrace technology and to be able to resell things. And so we built ourselves some optionality. So that's part one. Part two is, I mentioned in just one line in the presentation that we as part of the build out of the team in Sri Lanka, we're also hiring data professionals. So some of that is for us to collect data ourselves directly. Some of it is around using natural language processing, NLP, to be able to scrape data using machine learning technologies as well. So we're working on all sorts of different solutions to that problem of owning the data and being able to resell it. Let's see what else we've got. We've got one more. Matthew, Odie, it's a comment and a question, I guess. I'll just read it. Matthew, Odie, and Peter, thank you for the helpful update. Business continues to progress well. Just going back to the revenue split, you've previously highlighted the growing contribution from fund administration, which I think to mean outsourcing, and data and analytics. As the business grows, do you have an optimal split, e.g., legal 20%, fund admin 40%, analytics 40%?
Yeah, let me answer that. I mean, obviously, it varies a little bit between revenue and Ebitda because the outsourcing is higher margin than advisory, and analytics should have higher margin than outsourcing, which has got a lot more operational leverage in data and analytics. So slightly different between the revenue and Ebitda, but unquestionably, advisory will be increasingly the smallest part. It's really a mousetrap in many ways. And so that will decline as we said it would on the IPO. Not that I'm trying to belittle it, because actually it's a key part of what we do. Is the trusted advisor status, it's the clever people part of it, the pointy heady bit, as opposed to the pointy technology bit at the end. So it's important, but it will decline. I think the question on that, if you don't mind me answering with a question, which is the question we ask ourselves, is how much will we become a data and analytics software business as against an outsourcing admin business? That is the question which we ask ourselves. And I think we have to leave that question live for a while longer. We're building the software products. We've got an edge on the competition here. ESG has been a great driver of it. So we could end up with data analytics being the biggest part.
It's good to have options.
But outsourcing is also very good because it's 100% contracted revenue on sort of funds which typically last up to 15 years. So that is the only question. But undoubtedly, advisory will decline, and the only question is how much of the weighting. I mean, it feels to me like data analytics will be the biggest part, but we like outsourcing as well.
Okay, we've got another one. Do larger clients like to have a diversified base of service providers rather than rely on one or two companies? And so would this offer opportunities in the future?
Yeah, let me answer that. So certainly the end-to-end platform works well for small and mid-cap managers. It's fund in a box or fund manager in a box. You get it all, great. If you're a big manager, and initially, by the way, the whole company was built really for small to mid-cap managers. It was the democratization of the industry, as I mentioned, providing the KKR, Blackstone, Carlyle, BlackRock infrastructure to the smaller people. So the fund in the box, the multi-services works very well with small to mid-cap, and also work. But they grow, as you add fund 2, fund 3, fund 4, fund 5. So even Blackstone started somewhere once on fund 1 or 2. So we will grow with our clients there. But the data analytics is one which the big people we can sell to because they don't really need so much the advisory and outsourcing. So they got it internally. Yes, your question is very good because the biggest clients will buy data analytics easier. But having said that, there's a number of different tools there. So we found now, for example, in Ireland, where we've got big clients, multi-billion AUM clients, which because Ireland's more of a liquid market, we provide the outsourcing Manco offering in the mid office. However, we found actually it's quite easy to package in, going back to Odie's point about trialing the products in our own system, a bit like Moody's was a rating agency, and then it started providing analytics services internally and then sold them externally. So where Moody's Analytics is now almost the biggest, most exciting part of Moody's. Odie came from Moody's, by the way. So I think we found in Ireland we can package the outsourcing with some ESG and some benchmarking, 2 products from analytics. So the big players essentially it's easier to sell the analytics and then work backwards, if I put it that way, into the other services. Or there's a big client we have. We got. Well, I think I can mention it because it's public information. Wilshire's a big client in the US in our market, and when they launch a particular niche thing or particularly European thing, because they're American, then they might come to us. Hamilton Lane's a big client, but they use our European outsourcing operations for their European component, which is only, say, 10% of their global, or less than that. So we can also hit the bigger guys when they come to Europe, let's say, as well, or they're launching a very niche thing. We run a fintech incubator for FTSE 100 bank. Again, big client, FTSE 100 bank, but it's a niche offering of theirs. Or their mainstream manager launching an alternative or private funds initiative. A lot of active asset managers are now greedy for the active private funds world because the fees are higher. So when they launch niche, alternatives product, we can sell into them. So a slightly complicated answer, but hopefully that gives you a feel for it.
Okay, I've got a couple more, and then we'll probably run out of time. I'm not sure we'll get to all of them. You made 3 bolt-on acquisitions in FY21 utilizing the new Santander facility. In terms of making larger acquisitions, could you comment on the funding requirements? Do you have an optimal capital structure level of debt in mind?
Let me take that as well. Risk of being a bit dominant on here. Our acquisitions are bolt-ons, so they are sort of services-driven, solutions-driven, client-driven. However, it's likely we will make bigger acquisitions. That's why we IPO'd, frankly, as and when they come up. There's a bit of a feeding frenzy at the bigger end right now with private equity, so frankly, it's quite competitive up there. It's difficult to compete because valuation in the private world in our area is actually higher in the private world than it is in the public world. But we will make sort of bigger acquisitions in terms of the right equity and debt. We're quite very conscious of what the market likes and doesn't like in debt. So it might be the 3 times Ebitda kind of number, but going into 2s very quickly in debt. And equity, I am the biggest shareholder. I'm protective for all of us on dilution. I don't want to be diluted at what I think is an unfair price. But we will raise equity as well. So I think the ideal combination is probably might go into like 3 times or even 4 times Ebitda on debt for a few months before it goes down into the high 2s. And equity is clearly the rest.
Okay. There's 3 more questions. I don't think we have time to get to them. Just one of them is kind of a comment and a question, which is, do we do enough with retail investors? And most small company investors don't know MJ Hudson and aren't aware of what MJ Hudson do.
That's easy. No, we don't, and we need to do a lot more.
Exactly. We need to do more. I thought that would be an easy one to answer.
Yeah.
I think we're probably out of time. So Matthew, do you want to go back to your concluding slides? I've already put it on.
That'd be fantastic, guys. Thank you so much for answering so many questions. Of course, any further questions that do come through, the team will have the ability to review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. We are just coming up to the last couple of minutes, so thank you both for the presentation and the Q&A session. Matthew, perhaps I could just ask you for a closing snapshot to conclude before we redirect the investors to give you some feedback.
Yeah, so fundamentally, MJ Hudson is a way for investors to gain exposure to the growth in private markets, alternative investments, private equity, private debt, etc. We are a picks and shovels company in providing the mid and back office and the services in what's the fastest growing part of the $100 trillion asset management industry. Private market is the fastest growing part of that. What makes us special, we believe, is that we stay with our clients through the lifetime of their funds, often 15 years, so a long time. And we collect a huge amount of data on matters we've already discussed, like investment returns and ESG. And we use this data to provide services, but also to benchmark how well our clients are doing. So in many ways, we're a picks and shovels company with the security and resilience of that business model. But in addition, we have the technology, software, services, fintech, I could even call it, side to what we do as well. Sales have really picked up in the second half of our financial year to June 21. We're back where we should be, which is double-digit organic growth. And we're seeing that level of growth continue through the first 5 months of the current financial year. Our strong brand and reputation are drawing clients and also talent. We're hiring people when they become available. And acquisitions also are attracted to us, and we support our acquisitions where things like culture is actually vital on the acquisitions we make. So overall, we feel very positive about the current financial year and the prospects for many years thereafter. Thank you all for attending.
That's fantastic. Thank you very much indeed, Matthew, Odie, Peter, for your presentation updating investors today. Can I please ask investors not to close the session? You should be automatically redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete, but it's greatly valued by the company. On behalf of the management team of MJ Hudson Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.
Thank you all.
Thank you.